Welcome! If you are new to the world of nonprofit financial statements, or even to financial statements in general, then you are in the right place. In this video, our goal is to describe the purposes and key features of basic nonprofit financial reports. On the screen, you'll see the list of reports we'll be covering. As we go through each report, we'll also call out elements that are specific to nonprofit organizations. Let's get started. In nonprofit accounting, under United States Generally Accepted Accounting Principles, or GAAP for short, a balance sheet is called a statement of financial position. This title better reflects the mission-driven nature of nonprofits. The statement of financial position provides a snapshot of an entity's financial health at a specific point in time. This might be the end of a month, the end of a quarter, or the end of a fiscal year. A fiscal year is a 12-month period that an organization uses for financial reporting and budgeting purposes. It does not have to match a calendar year, but it might. In this example, our snapshot is as of December 31st. In a few minutes, we'll talk about ways this financial report provides information about an entity's financial health, but first, let's cover what we'll find within it. What we'll find on the Statement of Financial Position are balances for an entity's assets, liabilities, and net assets. Assets are items of economic value that an entity owns or controls. Assets will include things like cash, receivables, which are amounts owed from customers, and fixed assets, such as land, buildings, and equipment. Liabilities represent items that an entity owes, such as financial debt or other legal obligations. Liabilities can include short-term obligations like payables, which are amounts owed to vendors, accrued expenses, a line of credit, and long-term debt, such as leases or mortgages. Net assets represent the financial resources available after subtracting liabilities from assets. In the for-profit world, this residual interest is referred to as equity, also called owner's equity or stockholders' equity. But in nonprofit accounting, we use the term net assets instead of equity because nonprofit organizations do not have owners or shareholders. You'll also notice that for a nonprofit, net assets are further classified into net assets without donor restrictions and net assets with donor restrictions. We'll talk more about this classification in a bit. Accountants call this statement a balance sheet because it reflects the accounting equation that must always be in balance. Assets equals liabilities plus net assets. So, in this sample report, we can see that it balances because total assets are equal to total liabilities and net assets. In practice, you might see the balance sheet displayed using a top-to-bottom approach, or as shown here, a side-by-side approach. Either way is perfectly fine. An important accounting concept to mention is that assets and liabilities are the result of accrual basis accounting. Using an accrual basis of accounting, revenue is recorded when it is earned, and expenses are recorded when incurred, regardless of when cash is received or paid. So, for example, accounts receivable represent amounts owed from customers for whom services or goods were provided, but the cash hasn't yet been received. Likewise, accounts payable represent amounts owed to vendors for which the nonprofit hasn't yet paid. We point this out because to be compliant with GAAP, financial reports must use the accrual basis of accounting. Speaking of assets, liabilities, and net assets, there are a few accounts that are specific to a nonprofit balance sheet. The first of these is contributions receivable, shown here under current assets. contributions receivable represent a donor's agreement to contribute cash or other assets. In the nonprofit world, this agreement to contribute is known as a pledge or a promise to give. Besides cash, which is always appreciated, it's not uncommon for donors to promise to give other financial assets, such as stocks or bonds. Donors can also promise to give non-financial assets, like buildings, vehicles, or even works of art. Whether financial or non-financial, the promise to give assets are reflected in the contributions receivable account. The second account to mention within other assets is restricted cash. Here it's titled Cash Restricted for Long-Term Purposes. Under GAAP, restricted cash must be presented separately in a nonprofit's financial statements. This helps financial statement readers assess what resources are available for general use versus those that are designated for other purposes. The third account unique to nonprofits is a liability account called refundable advances. Refundable advances represent contributed funds transferred to a nonprofit that a donor has requested be returned if the donor-specific stipulations are not met or waived. A common situation which can result in a refundable advance is when a donor stipulates a matching requirement. For example, you can keep this $10,000, but only if you raise another $10,000 within 90 days. Otherwise, I want the money back. In that scenario, the nonprofit will hold the $10,000 as a liability until it is able to raise the matching amount. This account is important because it documents the responsibility of nonprofit management to meet donor stipulations or risk forfeiture of the funds. The fourth item specific to nonprofits are net assets. As we've already mentioned, net assets represent the financial resources available after subtracting total liabilities from total assets. Under GAAP, nonprofits are required to classify and report net assets into two groups: net assets with donor restrictions and net assets without donor restrictions. If they like, nonprofits may break these classifications down even further. In this example, you can see that net assets without donor restrictions has been broken down into board designated and undesignated net assets. Board-designated net assets represent unrestricted assets that the nonprofit's board of directors has earmarked for future programs, investment, or other uses. Notice the focus on unrestricted net assets. Remember, only donors can impose restrictions. If a nonprofit board would like to set aside funds for future uses, they can do so, but they can only earmark funds that are unrestricted. Here, they have been set aside for the maintenance of the entity's building. We should add that having board-designated net assets is a good thing because it is an indication that a nonprofit is making an investment in its own financial sustainability. Speaking of financial sustainability, let's circle back to how the Statement of Financial Position provides information about an entity's financial health. The first way the Statement of Financial Position provides insight into financial health is simply in the presentation itself. In a Statement of Financial Position, assets and liabilities are displayed by order of liquidity. This means that assets will be sequenced according to their nearness of conversion to cash and liabilities according to their maturity. Using a classified balance sheet, as shown here, can be extremely helpful in providing information on liquidity. It's a presentation method used by both nonprofits and for-profits. In a classified balance sheet, assets and liabilities are organized into current and non-current categories. Current assets are those expected to be used or converted to cash within 1 year of the balance sheet date. Current liabilities are obligations due within 1 year, and non-current liabilities are those due after 1 year. Even if a classified display is not used, assets and liabilities should always be displayed by order of liquidity. To assess liquidity, compare current assets to current liabilities and ask, are current assets greater than short-term liabilities? If the answer is yes, as in this example, that suggests the organization can cover its immediate financial needs. The overall composition of an entity's assets, liabilities, and net assets also provides a window to evaluate an entity's financial health. What is the mix of current to non-current assets? For example, having a large percentage of assets tied up in property, plant, and equipment can impact an entity's financial flexibility. This is because fixed assets cannot be quickly converted to cash to pay bills or to respond to emergencies. Plus, owning buildings and equipment often comes with ongoing maintenance costs. However, if managed well, buildings and equipment that are essential to a nonprofit's mission, like a theater for an arts organization or a community center for a social service organization, can enhance an entity's impact and sustainability. As mentioned, setting aside funds to help with ongoing maintenance costs, such as the building reserve seen here, reflects a nonprofit's investment in its own financial sustainability. And finally, the last way to assess financial health that we want to mention is how restricted funds are managed. Remember, nonprofits are required to report net assets with donor restrictions separately from net assets without donor restrictions. Too high a percentage of restricted assets can limit an entity's financial flexibility. Likewise, a high amount of restricted assets combined with a negative amount of unrestricted net assets can be a red flag that an entity is dipping into donor-restricted assets to fund operations. While that's not the case here, having donor-restricted assets places a responsibility on nonprofit management to carefully steward those funds. To summarize, we shared 3 ways to assess financial health using a nonprofit's statement of financial position. 1, comparing current assets to current liabilities. 2, looking at the overall composition of assets, liabilities, and net assets. And 3, reviewing the management of restricted funds. The statement of activities is similar to the income statement of a for-profit organization. Having the word activities in the title spotlights the importance of tracking mission-related financial activity for a nonprofit. The statement of activities summarizes revenues and expenses over a specific period of time. This might be for a month, a quarter, or an entire fiscal year. In this example, our report is for an entire year. You might notice that, unlike for-profits, nonprofits use the term revenues and support instead of just revenues. This better reflects a nonprofit's ability to receive both earned income, like the program fee income shown here, and contributed income. Looking at expenses, in this example, they are listed by function. In the alternative, nonprofits might choose to display expenses by their natural classification. For example, listing out salaries, supplies, rent, etc. We'll dig a little deeper into functional expenses in a bit, but know that under GAAP, displaying expenses on the statement of activities using either approach is acceptable. Let's cover how the math works on the statement of activities. The difference between total revenues and support less total functional expenses is equal to the change in net assets, similar to the net income that might be shown on a for-profit's income statement. Under nonprofit accounting, the change in net assets must be classified and reported as increases or decreases in net assets without donor restrictions and net assets with donor restrictions. You'll notice how this entity has met that requirement using columns, which is by far the most common approach. Thus, we see the change in net assets without donor restrictions, the change in net assets with donor restrictions, and the change in net assets for the entity as a whole. One final piece of math. Our ending net assets should tie to those reported on our statement of financial position. So let's see if they do. Our ending net assets without donor restrictions equals the total shown on our statement of financial position, as does our net assets with donor restrictions, which equals the total shown on our statement of financial position. And finally, our total net assets on the statement of activities ties to the total reported on our statement of financial position. Everything ties, so it's good. Let's point out a few nonprofit specific elements that you'll find on the statement of activities. The first line item is contributions, and its partner, in-kind contributions. We've already mentioned that nonprofits can receive contributions in a variety of forms. They can receive donations of financial assets, such as cash or stock, and they can also receive what are collectively referred to as in-kind contributions. In-kind contributions are gifts of non-financial assets, such as land, buildings, materials, and even works of art, or the use of facilities and utilities, such as free office space, for example. Non-financial assets can also include donated professional services, such as legal, marketing, educational, or financial services. Under GAAP, nonprofits must present in-kind contributions on a separate line on the statement of activities, as shown here, apart from gifts of cash and other financial assets. Contributions can also come with donor-imposed stipulations that restrict the purpose or time under which a contribution can be used. Nonprofits are required to distinguish between contributions received with donor-imposed restrictions and those received without donor-imposed restrictions. Donors can impose restrictions that are temporary in nature, and those might be contributions to be used after a specified date, for a particular program, or to acquire buildings or equipment. Whereas other donors might impose restrictions that are perpetual in nature, such as investments that must be maintained in perpetuity. You may hear these referred to as permanent endowments. Whichever type of donor-imposed restriction, it's important to note that these stipulations place a responsibility on nonprofit management to use those contributed assets as the donor requested. Speaking of using contributed assets as requested, let's draw your attention to the next nonprofit specific element, and that is net assets released from restriction. Net assets released from restriction represent reclassifications of previously restricted net assets. Releases occur as donor stipulations are met. Because these releases are simply reclassifications from one class of net assets to another, there will be no impact to the financial statement total. Let's shift our focus now to expenses. First, we want to point out two items about expenses unique to nonprofit reports. The first is that investment expenses should be netted against investment return, as shown here. And the second is that nonprofits have the option to report special events net of any direct costs. For example, the cost of meals or facility rental for an event. Other than those two special cases, expenses are shown within the expenses section of the statement of activities and reported as decreases in net assets without donor restrictions. Finally, we have the difference between revenues and expenses, or the change in net assets. Remember that under GAAP, we must display the change for each net asset class and for the entity as a whole. Because of the impact of multi-year grants, it's not uncommon to see a negative amount reported under the change in net assets with donor restrictions column. While in our example, the amount is positive, if this nonprofit had made significant spending on previously restricted grants or contributions, the releases for the year might be greater than incoming contributions, and that's okay. What wouldn't be okay is if there is a negative change in net assets under the without donor restrictions column. A negative balance here warrants further investigation. Obviously, reporting a negative balance over multiple years would be an indication of issues with financial sustainability. The takeaway that we want to emphasize is to review each of these columns and not just focus on the total column. Let's move on to our next report, the Statement of Functional Expenses. All nonprofits are required to report information about expenses on the face of the Statement of Activities, in notes to the financial statements, or as a separate financial statement. Most nonprofits choose to meet this requirement by providing a separate financial statement. That financial statement is called a Statement of Functional Expenses. The Statement of Functional Expenses summarizes an entity's expenses over a specific period of time. In this example, our report is for an entire year. On this statement, expenses are reported by both their nature and their function. Functional categories include program services and supporting activities, such as management and general activities and fundraising activities. You may recognize that these categories correspond to the functional categories listed on the Form 990, the annual information return that many nonprofits file with the IRS. There's a bit of math involved in this report as well. The total expenses on the Statement of Functional Expense should tie to the total expenses reported on the Statement of Activities. Here's a quick review of each of the categories on the Statement of Functional Expenses. Program expenses are expenses directly related to carrying out a nonprofit's mission. Fundraising activities are expenses incurred to induce potential donors to contribute money or other assets. These activities might include things like conducting fundraising campaigns or events, preparing and distributing fundraising materials, and the salaries of staff or consultants hired to help with fundraising activities. Management and general activities are any expenses related to the oversight and governance of a nonprofit. Generally, they will be those that cannot be directly identified as either program or fundraising. Examples might include the salaries of support staff, like the executive director, finance staff, and human resources staff, as well as general office expenses and interest. In addition to the three categories shown here, some entities might show an additional category for membership development activities, such as soliciting for prospective members and collecting membership dues. Collectively, fundraising, management in general, and membership development activities are known as supporting activities, and they represent all activities other than program expenses. Finally, we should mention that nonprofits are required to document the methodologies used to allocate costs among their functional expense categories. Common allocation methods include percentages of time and effort, also known as payroll percentages, or estimates of square footage. Functional categories, in addition to being required by accounting rules and the IRS, are scrutinized by donors and charity watchdogs, who often look at the percentages of each of these categories compared to total expenses. Regardless, this level of expense detail is unique to nonprofit accounting. The Statement of Cash Flows reports how cash moves in and out of an entity over a specific period of time. In this example, our report is for an entire year. Cash receipts and cash payments are classified as operating, investing, or financing activities. These categories are the same three categories used by for-profit organizations. Operating activities are generally transactions related to the production of net income, such as cash received by customers, through program fees or donors, or payments and deposits made to vendors. Investing activities will include cash flows related to acquiring or disposing of fixed assets or investments, or making or collecting loans provided to others, as some nonprofits may do. Financing activities will include cash flows related to acquiring or repaying capital, such as acquiring or repaying leases, loans, and mortgages. Specific to nonprofits, you might also find reported here contributions, and investment income restricted for acquiring long-lived assets, such as for a capital project. Unlike for-profit organizations, nonprofits are not required to provide a reconciliation of the change in net assets to net cash from operating activities. If an entity paid interest or taxes, yes, some nonprofits may be responsible for paying tax on unrelated business income. Those transactions require a separate disclosure. The amounts listed in that disclosure should be the actual cash payments made, not accrued. Finally, non-cash investing and financing activities require yet another disclosure. Examples of those types of transactions might be contributions of property, buildings, or equipment, purchasing a building by incurring a mortgage, or obtaining an asset by entering into a capital lease. And, of course, we must mention how the math works on the statement of cash flows. The change in net assets should tie to the change in net assets on the statement of activities. Ending cash should tie to the total cash, cash equivalents, and restricted cash that is shown on the statement of financial position. But you may have to perform a little addition to confirm that it balances. When reviewing the statement of cash flows, here are a few things to look for. Within operating activities, look for positive changes in cash flow from operations. A healthy nonprofit needs to have enough cash flow to support its day-to-day operations. Within investing activities, periodic purchases in facilities and equipment are a positive sign of growth and investment in new technologies. On the flip side, the selling of large amounts of property or investments may be an indication of financial stress. Within financial activities, debt repayments can be a positive sign that an entity is able to service its debt, but heavy borrowing or frequent draws on a line of credit may be an indication of debt dependency and the need for better long-term planning. This concludes our review of a basic set of nonprofit financial reports. We reviewed the purposes and key elements of a statement of financial position, a statement of activities, a statement of functional expenses, and a statement of cash flows. This recording was brought to you by your part-time controller, or YPTC for short. Want to learn more? Visit us at yptc.com. Thank you for watching.